Let's turn now to how California's municipalities have fared after past recent fires and what that could tell us about what might happen now. Nuveen's Dan Close is here. Dan, appreciate your time. And people are just trying to, I'm hearing reports now questioning whether LA can put on the Olympics in 2028. So there's a lot of concern about how exactly this is all going to pan out in the next few years. What should we anticipate?
Yeah, and first, certainly heartfelt sympathy for all those impacted by the wildfire. But, you know, I think the main point that we're seeing from the muni market is that muni investments do remain safe. If you look at past experience with natural disasters, you haven't seen defaults, you haven't seen meaningful downgrades, you haven't seen long-term credit deterioration. And I think this is certainly the case here. If you look at the two most recent disasters that were, certainly the largest, Hurricane Katrina, Superstorm Sandy, and look at the municipal experience. No defaults in either of those. And just drilling down a little bit further, Hurricane Katrina, there's $125 billion of damage. 1 million people were displaced. The federal government came in with $120 billion. There was eventually 29 or 30 downgrades, but no payment defaults. And I think when you look at Superstorm Sandy, 665,000 homes destroyed, $75 billion in damages. The federal government came in with $50 billion, and we didn't have any defaults there. So I think as we look at this and just the absolute horrible images on TV, it's important just to separate the credit side. And traditionally, municipals don't have that defaults when you have these types of natural disasters.
I'm sure there are investors who are looking through, especially if they live in the area and have exposure and go, what do I need to do now? So that perspective is helpful. In terms, also, I thought this was interesting of what California has done during past wildfires. Assessed valuations hold up pretty well, as we know. I mean, the housing market just continues to increase in value. They even have backfilled lost property tax revenues in the past, which I thought was super interesting. There's hold harmless provisions allowing schools to be funded at pre-disaster enrollment levels. So there's actually a big undertaking here.
Yeah, there's a lot of mechanisms in place, for schools and for getting your funding from the state level. Those hold harmless are very, very important. And I think what you look at, too, is how municipals are trading in the midst of natural disasters. So you look all the way back to the polar vortex of 2021. Spreads did widen out a bit, but right now with the retail investor base, we're really not seeing a lot of spread widening, but for one or two names. And I think that's going to be the case here, where these credit mechanisms in place, I think, really do give investors a lot of confidence that you're not going to see these large-scale defaults because of the natural disasters.
What can you tell us, I don't know if you've seen it sort of that specifically, but about Los Angeles' general creditworthiness, right?
Sure.
This is an area where this is shining a light to some extent on some of the economic challenges they've had. Maybe it hasn't impacted the cost of real estate, but the vibrancy of the economy more broadly. Is there any reason to be concerned about that?
Yeah, you look at, for instance, one of the most widely held credits in California, Los Angeles Community College District. $1.2 trillion assessed base. You look at that in its totality and where these fires are. And it's when you have a tax base that big and you have the largest community college district in the United States, these sorts of things, they're absolutely tragic. But from a credit standpoint, it just really doesn't have an impact when you have such a large base for taxation.